Last month, nationwide reported house prices rose nearly 1%, overturning expectations of another house price fall. Now, prices may be 3% lower than this time last year, but this unexpected rise in prices has caused some commentators to ask whether the market has already reached its trough and whether the house price correction is already over. With inflation falling and interest rates peaking, is that it? Is the long anticipated correction already over? But how much weighting can we give to 1 month's data, and what is really going on with house prices and the housing market? The first thing to understand is that the many house price indexes are all compiled in different ways. The nationwide is one of the oldest and most established indexes, and it's derived from its own data on mortgage approvals when people buy a house. Therefore, with a significant fall in transactions, the index is using quite limited data, and there's a lot of statistical regression to come up with the house price index. Last month, the Bank of England reported a further decline in housing activity. With these very thin volumes, monthly data can reflect a lot of noise, which is why it's best to ignore monthly changes, whether they go up or down, and look at 12-month figures. However, there is always a danger that when data doesn't show you what you expect or perhaps hope, we start blaming the reliability of the data. What can we be really certain of in the current climate? Well, there is one very clear story from the UK housing market, and that is a fall in transactions, a fall in mortgage approvals, and a fall in home sales. Those seeking to move house are finding it much more difficult, with an increase in the length of time taken to complete a move. We've been left with a stagnant market. It's like a game of poker between buyers and sellers. Sellers are reluctant to reduce their asking prices, and buyers are either unwilling or unable to pay the current asking prices. Zoopla, in their recent report on the housing market, show a sharp contrast between the number of homes for sale, which is increasing, and buyer demand, which is falling. And as any good A-level economic student will tell you, the basic economic impact of this higher supply and falling demand should be lower prices. So a price rise in this climate is somewhat unexpected. But why is the market stagnating, and what will it take for prices to adjust? The housing market is atypical in that prices can be very slow and sticky to change. And this is for quite a few different reasons. Homeowners get quite attached to past values. In psychology, a very important element is that we don't like to lose. For example, if your house has been valued at $270,000, we find it very hard to accept a loss on this past value. The best advice I ever gave on the housing market was to a friend, and I advised them to sell at a loss of £5,000 to enable them to complete their move to their dream home. The problem was they were very fixated on the idea they had to get the price they paid. And they would eventually have done that, but by the time they'd got the asking price they wanted, their dream home would have increased out of their reach, and they would have missed the opportunity. In economics, this is known as the sunk cost fallacy, making decisions influenced by past investment and past prices. This is an important lesson for sellers. Don't set the price on what you think you deserve or on past values. Set the price depending on what will sell at current market conditions. That's the most important thing. Now, the other reason we're having a standoff between buyers and sellers is that buyers have still been hammered by the effect of all the interest rate increases over the past few months. And it's this that's caused the amount of mortgage lending to fall considerably. For example, if we go back to 2020, with interest rates at 2%, a typical buyer who could afford £1,200 a month could borrow £283,000. But in 2023, with interest rates at 5%, the amount they can borrow has fallen to £205,000, a quite significant fall. However, this analysis does need some evaluation, because since 2020, high inflation has caused nominal wages to increase by around 16%. So with rising salaries, the nominal amount people can afford to pay has risen 16%. So if you could afford $1,200 3 years ago, the inflation-adjusted amount you could spend on mortgage is $1,392. Therefore, with this rise in nominal wages, the mortgage you could borrow is actually $238,000, still less than 2020, but not as bad as first appearances might suggest. And furthermore, if you took out a 40-year mortgage rather than 25, the amount you can borrow is actually $288,000, which is actually more than 3 years ago, or that's an extreme example of going from 25 to 40. Also, because of rising rents, where possible, people have been spending more of their income on mortgages, and we can see the share of income spent on mortgages rising, not quite as bad as previous crashes, but still causing significant pain. Also, on the other hand, the rise in nominal wages has been an important factor in pushing more people into a higher income tax bracket. Freezing income tax threshold has been a very effective way to raise taxes for the government, because with rising nominal wages, more and more people are being sucked into the higher tax bracket. Any income earned over $37,000 is taxed at 40%, but with inflation pushing up nominal wages, we are effectively paying more tax, which is also reducing affordability. Also, I do feel that the rising rents we've seen in recent years have been very important for kind of pushing up house prices, because it's more attractive than the alternative of renting. But we are starting to see the first signs of a cooling in the rental market, and if rents were to fall next year, that would be a big factor in reducing demand for buying, because people would be happy to keep renting. So this is why, despite higher interest rates, things are not quite as bad as they may first appear, which is why I think that really big predictions of nominal house price falls will not happen. Rising wages will do a lot of the heavy lifting in reducing historically overvalued house prices. And it's very likely we shall see continued falls in real house prices. Now, at this point, you might say, it doesn't feel like my wages are rising. Everything is getting so expensive. And it's true, real wages have been almost stagnant in the past 2 or 3 years. They haven't done very well for over a decade. And this is why that the real house prices adjusted for inflation have fallen much more than nominal prices. Now, on the positive side, the outlook for real wages is starting to look a little bit more optimistic than in the past. Inflation is starting to fall. It's predicted it will come down quickly over the next few months, although with the usual caveat, inflation predictions haven't always been very good in the past couple of years. But if it does start to fall, we should start to see real wages rising and starting to offset some of the past couple of years with falling real wages. A big factor is it will all depend on the state of the overall economy and the labour market. There are signs of rising vacancies, slight rise in unemployment, and a slowdown in the economy. And I don't believe the UK ever had wage push inflation. Labour bargaining power in the UK is very weak. What was really happening is that workers have been trying to catch up with inflation. And so as inflation falls, I think you'll see nominal wages also start to fall fairly quickly too. But before we declare the whole correction is over, I think there's another important caveat, which is the impact of higher interest rates are still to be fully felt. Over the next few months, millions will face remortgaging to significantly higher mortgage rates. And this will have two big effects. Firstly, it will cause distress for homeowners, causing pressure to maybe sell, downsize, or even go into arrears. And any increase in supply into the market with very limited buyers will cause prices to drop. The second impact is that higher interest rates will lead to lower consumer spending and lower investment. And one of the ironies of recent months is that the effect of higher interest rates has been that the increase in saving interest payments has been greater than the increase in debt payments. In other words, savers have immediately benefited from rising rates, but borrowers have often been insulated by being on fixed rates. So there hasn't been much downward pressure on demand from the higher interest rates that you might expect. But this will change over the next year because more and more borrowers will face higher interest rates. Now, last month I was critical of the Bank of England for increasing interest rates because I think that in 2024 we will see a big delayed effect of past interest rates on the economy and the housing market. So it's very premature to talk about the impact of interest rates peaking. There's still more pressure from higher rates to come. Another intriguing question about the current housing market is who are all the cash buyers? Zoopla report that cash buyers have jumped from 20% of the market to 32%. Buy-to-let has shrunk from 9 to 6% as you might expect. So who are these cash buyers? Well, they include institutional investors who can afford to buy straight off. but there's also people who've paid off their mortgage completely and can buy either to downsize or upsize or move. Also, we haven't really mentioned the importance of supply in the UK housing market. And as mentioned before, the UK has nearly always failed to meet government targets, not building enough. And to some extent, this may prop up prices a little bit, although less than you might expect in the short term. But the big question in the long term is, with the still quite high overvalued prices, do we really need to build 1.5 million new homes, as the next Labour government are promising to do? Now, you might be sceptical about their house promises, given that past record of governments is very poor. But this video looks into all the pros and cons of a massive home building programme and whether we really need to do it to tackle the housing crisis once and for all. Thanks for watching, hope you've enjoyed it, and please subscribe.